Imagine you are standing at the edge of a very noisy marketplace. People are shouting prices, some are excited, some are scared. Some are telling you to buy now before it is too late, and others are warning you that everything is about to crash. This is the world of investing. The book, The Intelligent Investor by Benjamin Graham, was written to help people stay calm in this noisy place. It was not written to make you rich quickly. It was written to help you avoid big mistakes, protect your money, and grow wealth slowly over time. This book has influenced many great investors, including Warren Buffett, but it was written for ordinary people. The main idea of the book is very simple. Investing is not about being smart or fast. It is about being patient, careful, and emotionally strong. Graham begins by explaining the difference between investing and speculation. He says that investing means you put your money into something only after careful study. You expect a fair return, and you protect yourself from serious loss. If you do anything else, he says, you are speculating. Many people think they are investing, but they are really speculating without knowing it. When someone buys a stock just because it is going up, that is speculation. When someone buys because a friend said it will double, that is speculation. Even professionals can speculate if they ignore value and risk. Graham is not saying speculation is evil, but he is saying it is dangerous if you confuse it with investing. The first lesson of the book is to always know which one you are doing. To help explain how the market behaves, Graham introduces one of the most famous ideas in all of investing. He creates an imaginary character named Mr. Market. Mr. Market is your business partner. Every day, Mr. Market comes to you and offers to buy your share of the business or sell you his share. The strange thing about Mr. Market is his mood. Some days he is very happy and excited. On those days, he offers very high prices. Other days, he is sad and scared. On those days, he offers very low prices. The important lesson is that Mr. Market does not tell you what your business is worth. He only tells you what he feels like paying today. You are not required to agree with him. You can ignore him completely, or you can take advantage of his mood swings. When he is depressed and offering low prices, you can buy. When he is excited and offering high prices, you can sell. The mistake most people make is that they do the opposite. They buy when Mr. Market is excited and sell when he is afraid. This leads into one of the most important ideas in the book, the idea of intrinsic value. Intrinsic value is what a business is actually worth based on what it owns, how much money it makes, and how strong it is financially. Graham explains that the price changes every day because of emotions, news, and fear. The value changes slowly. Graham says you should focus on value, not price. He also says that intrinsic value is not a single exact number. It is a range. You cannot calculate it perfectly, and that is why you must be careful. Because value cannot be known exactly, Graham introduces the idea of a margin of safety. He compares investing to building a bridge. Engineers do not build bridges that can only carry the exact weight expected. They build them much stronger than necessary. Investors should do the same. If you believe a business is worth $100, you should not buy it at $95. You should buy it at $60 or $70. That difference is your margin of safety. It protects you if you are wrong. It protects you if the economy gets worse. It protects you if the company has problems. Graham says the margin of safety is the central idea of investing. Without it, you are guessing. Graham also explains that people think risk means price movement, but he disagrees. He says risk is the chance of permanent loss. A stock going down in price is not risky by itself. It becomes risky only if you panic and sell or if you paid too much in the first place. Volatility, which means prices moving up and down, is normal. Graham says volatility is actually helpful for the intelligent investor because it creates opportunities. When prices fall for emotional reasons, good businesses can be bought at low prices. The danger is not the market. The danger is your own behavior. Another major part of the book is Graham's idea that not all investors need to work hard or study deeply. He divides investors into two types: The first is the defensive investor. This investor wants safety and simplicity. The defensive investor does not try to beat the market. They focus on diversification, quality, and long-term holding. Graham suggests that defensive investors own a mix of stocks and bonds and rebalance from time to time. The defensive investor avoids excitement and avoids predictions. This type of investor accepts average returns and focuses on avoiding big losses. The second type is the enterprising investor. This investor is willing to work harder and spend time studying companies. The enterprising investor looks for stocks that are undervalued, unpopular, or ignored. These might be companies with temporary problems, companies in boring industries, or companies that are misunderstood. Graham explains that this approach requires discipline and emotional control. It is not for everyone. He warns that trying to be enterprising without the right mindset leads to mistakes. One of the things Graham strongly believes in is diversification. He says no matter how careful you are, you will make mistakes. Some investments will not work out. Diversification protects you from being wrong. Graham suggests owning many different stocks rather than putting all your money into one idea. Even if one investment fails, the others can still succeed. He says concentration increases risk, not intelligence. Graham spends a lot of time talking about financial strength. He likes companies with strong balance sheets, low debt, steady earnings, and long histories. He prefers boring, stable companies over exciting stories. He warns against companies that rely heavily on future growth to justify high prices. He shows that many glamorous companies of the past disappointed investors because people paid too much for hope. Another important part of the book is Graham's advice on bonds and stocks. He believes most investors should own both. He suggests adjusting the mix based on market conditions, but never going to extremes. He does not believe in putting all your money into stocks, even when times are good. He believes balance reduces risk and helps investors stay calm during market downturns. Throughout the book, Graham often talks about investor psychology. He explains that fear and greed cause most mistakes. People feel smart when prices are rising and foolish when prices are falling. Graham teaches that you must train yourself to act differently. You must buy when others are fearful and be cautious when others are excited. This is not easy. It requires emotional discipline more than intelligence. Graham also warns against listening to forecasts. He says no one can consistently predict the market. Economic forecasts, market predictions, and expert opinions are often wrong. He advises investors to focus on what they can control, which is price paid, diversification, and behavior. Trying to guess the future leads to overconfidence. One of the strongest themes in the book is the importance of avoiding big losses. Graham says you do not need to make extraordinary gains to succeed. You only need to avoid disaster. Compounding works if you survive. Losing 50% requires 100% gain to recover. Graham believes protecting capital is more important than chasing returns. As the book continues, Graham gives examples of investors who were ruined by leverage, speculation, and overconfidence. He talks about the stock market crash and how many people borrowed money to invest, believing prices could only go up. When prices fell, they were forced to sell at the worst time. Graham repeatedly warns against borrowing to invest. The tone of the book is calm and practical. Graham does not promise excitement. He promises safety and reason. He believes investing should be boring. If it feels thrilling, something is probably wrong. He encourages investors to think like owners, not traders. By the end of the book, the main message becomes very clear. You do not need to be smarter than others. You need to be more disciplined. You need to control your emotions. You need to respect risk. You need to demand a margin of safety. The market will always be emotional. Your job is to remain rational. The Intelligent Investor is not a book about beating others. It is a book about mastering yourself. It teaches that the biggest enemy of the investor is not the market, the economy, or bad luck. The biggest enemy is inside your own mind. If you take only one lesson from this book, it is this: price is not value, the market is not always right, and patience is more powerful than prediction.